What if I told you that something happened just 2 days ago that signals the beginning of the biggest monetary shift in 80 years? While most people were wrapping up their holiday celebrations, completely unaware, a critical threshold was crossed, one that monetary historians have been watching for decades. Silver hit $80 an ounce on December 27th, 2025. Now, before you dismiss this as just another commodity price fluctuation, let me show you why this particular number, at this particular moment, matters more than almost anything you'll see in the financial headlines this year. This isn't about making you panic. It's about giving you the historical context that most people will never see until it's too late. Stay with me for the next few minutes, because what I'm about to share connects patterns from 1781, 1865, 1934, and today into one coherent picture. And by the end, you'll understand why silver at $80 isn't just a price point. It's a signal. Let me start with something most people don't know. Throughout American history, major monetary crises have occurred in a remarkably consistent pattern roughly every 80 years. I'm not talking about recessions or even depressions. I'm talking about fundamental restructurings of what money actually is and how it works. The Revolutionary War era around 1781 saw the complete collapse of the continental currency. America's first paper money became so worthless that the phrase "not worth a continental" entered the vocabulary. The Civil War period, around 1865, brought the greenback inflation crisis and the end of the classical gold standard as it existed before the war. Then came 1944 and 1945, when the Bretton Woods system established the dollar as the world's reserve currency, backed by gold at $35 per ounce. Each of these crises fundamentally changed how Americans use money. And here's what should make you pay attention. It's been exactly 80 years since Bretton Woods. We're sitting in 2025, rolling into 2026, at precisely the point where historical patterns suggest the next transformation should occur. Now, you might be thinking that's just coincidence, random pattern matching. But here's where it gets interesting. The mechanism behind each crisis has been remarkably similar. Governments accumulate more obligations than they can possibly service with existing revenue. They try various financial engineering tricks to keep the system running smoothly. They assure everyone that everything is under control. And then, eventually, the mathematics becomes impossible to ignore, and a system has to restructure, and that restructuring always involves precious metals in very specific ways. Always. Let's talk about silver specifically, because this is where most people miss the significance. Silver has this unique dual nature that makes it critically important during monetary transitions. On one hand, it's an industrial metal. It goes into solar panels, electric vehicles, electronics, medical devices, real economic uses that create genuine demand. On the other hand, it's been used as money for thousands of years. It's one of the few physical assets that humans instinctively recognize as having lasting value. When monetary systems come under stress, silver starts behaving in predictable ways. And right now, we're seeing exactly that behavior. Here are the numbers that should grab your attention. Industrial demand for silver hit record levels in 2024. Over 680 million ounces consumed. Solar panel manufacturing alone now accounts for nearly a third of all industrial silver demand. And that sector is still growing rapidly. Electric vehicles use 2 to 3 times more silver than traditional cars. The artificial intelligence boom requires massive data centers, all of which need silver in countless components. Meanwhile, mine production has been essentially flat for years. We're now in the 5th consecutive year of supply deficit in the silver market. 5th consecutive year, more silver is being consumed than produced, and the gap is widening. So we have record industrial demand pulling silver out of available supplies, stagnant production that can't keep up, and a monetary system carrying $38 trillion in national debt. That's a trillion with a T, more debt than any previous generation could have imagined possible. And that's just the federal debt. It doesn't count unfunded entitlement obligations, which add tens of trillions more to the real picture. But here's what makes December 27th, 2025 significant beyond just supply and demand fundamentals. Silver crossing $80 represents the market beginning to price in what comes next, not what is happening now, but what historical patterns suggest is approaching. Let me explain what I mean by walking you through the clearest historical precedent we have. In 1933 and 1934, America faced a monetary crisis that looks remarkably similar to our current situation in several key ways. The government was drowning in debt from trying to combat the Great Depression. The banking system was collapsing, public confidence in the dollar was evaporating, and the gold standard, which had backed the dollar for over a century, was becoming mathematically unsustainable given the government's obligations. President Franklin Roosevelt's solution was dramatic. In April 1933, he signed Executive Order 6102, which required Americans to turn in their gold coins, gold bullion, and gold certificates to the Federal Reserve in exchange for paper dollars at the rate of $20.67 per ounce. Citizens had until May 1st to comply. After that date, possessing monetary gold became a criminal offense, punishable by up to 10 years in prison and fines of up to $10,000, which would be roughly $230,000 in today's money. The government collected the gold at $20.67 per ounce. Then, just 9 months later, in January 1934, the Gold Reserve Act officially reset gold's price to $35 per ounce, a 69% revaluation overnight. Think about what that meant. The government forced citizens to sell their gold at one price, then immediately revalued it at a much higher price, capturing that difference for itself. It was a direct transfer of wealth from private citizens to the federal government, designed to devalue the dollar's obligations and give the government more flexibility to finance its programs. This wasn't some authoritarian impulse unique to Roosevelt. It was standard monetary crisis management. When governments accumulate unsustainable obligations, they eventually have to devalue the currency. The 1934 episode just made the process explicit and visible in a way that future devaluations would obscure through more subtle mechanisms. Now, here's the part most people don't realize. Silver was part of that 1934 restructuring too. The government didn't just focus on gold. It purchased massive amounts of silver through various programs, driving the price from around 25 cents per ounce to over $1.229. By 1935, a more than five-fold increase in less than 2 years. Why? Because silver was still monetary metal at that time. And controlling both gold and silver gave the government complete control over the monetary reset. The pattern was clear. First, the government intervened in the gold market. Then it intervened in the silver market. Both interventions served to devalue the dollar's real purchasing power while nominally increasing the price of the metals themselves. Fast forward to today, we have a government carrying $38 trillion in explicit debt, plus unfunded obligations that dwarf that number. We have interest payments on the debt that now exceed defense spending and most other major budget categories. We have entitlement programs projected to become unsustainable within the next decade as demographics shift. We have a Federal Reserve that expanded its balance sheet to unprecedented levels and now faces political pressure every time it tries to normalize policy. And we have precious metals, particularly silver, beginning to move in ways that historically precede major monetary adjustments. Silver at $80 is the market's way of saying that smart money is starting to position for what historically comes next. Not today, not tomorrow, but within a window that history suggests could be relatively compressed. Once it begins, culture wars intensify. Think of the 1990s through the 2010s. So the fourth turning is a crisis. The accumulated tensions reach a breaking point, forcing fundamental restructuring of society, institutions, and often the monetary system itself. Here's what makes this framework relevant for understanding precious metals. Every fourth turning in American history has corresponded with a major monetary transformation. The Revolutionary War, fourth turning, brought the continental currency collapse and the eventual establishment of the Coinage Act of 1792, which based American money on gold and silver. The Civil War, fourth turning, brought greenback inflation and the eventual return to a modified gold standard. The Great Depression and World War II, fourth turning, brought the end of domestic gold ownership and the Bretton Woods system. And now, if the pattern holds, we're in another fourth turning, and the monetary system should be approaching its transformation point. You can be skeptical of cyclical theories. That's reasonable. But even if you don't accept the mechanism, the correlation is undeniable. Major monetary changes in American history have clustered around these 80-year intervals with remarkable consistency. And those changes have always involved precious metals in central roles. So when silver crosses $80 in late 2025, early 2026, it's not happening in isolation. It's happening at exactly the historical moment when patterns suggest a monetary transformation should be approaching. Let me give you some specific numbers about our current situation so you can judge for yourself whether the comparison to previous crises is fair. The United States currently has $38 trillion in federal debt, and that's up from about $5. The artificial intelligence boom has made silver essential. Data centers processing AI workloads need silver in countless components. This means that unlike 1934, when the government could manipulate silver prices without worrying too much about industrial disruption, today any attempt to control silver would immediately impact major strategic sectors of the economy. That creates a fascinating tension. The government might want to control precious metals during a monetary transition, but it can't afford to disrupt industrial supply chains for critical technologies. This constraint didn't exist in previous cycles, which means the mechanism of any intervention would have to be different. How different? We don't know yet, but the mathematics of the debt combined with the industrial reality of silver creates a unique situation that historians have never seen before. Let me share one more piece of the I find particularly compelling. Throughout 2024 and into 2025, central banks around the world have been accumulating gold at record pace. Not just emerging market central banks, which you might expect, but established institutions as well. The official explanations focus on diversification and risk management. But if you study monetary history, you know that central banks typically increase gold reserves before major monetary transitions. They're preparing. They know something is coming, even if the exact timing is uncertain. At the same time, silver inventories in major exchanges have been declining. The London Bullion Market Association, which tracks physical silver holdings, has shown consistent drawdowns. The COMEX warehouses in the United States have seen eligible silver inventories fall substantially. The Shanghai Gold Exchange shows similar patterns in China. This is happening while industrial demand is at record highs and mine production is flat. Where is the silver coming from to meet current demand? Existing stockpiles. And what happens when those stockpiles run low while demand keeps growing? Prices rise, potentially dramatically. This is the setup that silver at $80 is beginning to reflect. Not just current supply and demand, but the anticipation of what comes next when you combine monetary system stress with structural supply constraints. Here's what stage 6 might look like as it unfolds in 2026 based on historical patterns. First, you'd expect to see official narratives shift. Early in a crisis, governments deny there's a problem. The fundamentals are strong. The banking system is sound. There's nothing to worry about. As the crisis progresses, the narrative shifts to blaming external factors. This is because of foreign manipulation or speculation or market dysfunction. Eventually, if the crisis deepens, the narrative shifts again to preparation for intervention. We need to take extraordinary measures to protect the system if we're entering stage 6. Watch for that narrative shift. Are officials still denying there's any monetary problem, or are they starting to blame market dynamics and prepare the public for potential interventions? Second, you'd expect to see volatility increase, not steady, smooth price increases, but sharp moves up, followed by corrections, followed by more moves higher. This pattern characterized the 1970s gold and silver markets. It characterized the 2010 to 2011 silver spike. Volatility is the signature of a market trying to find a new equilibrium when fundamental conditions are changing rapidly. Third, you'd expect to see increasing disconnects between paper markets and physical markets. When silver trades on exchanges through futures contracts and ETFs, prices can be influenced by paper trading that has nothing to do with actual metal supply and demand. But when the physical market tightens, those paper prices become difficult to maintain. You start seeing premiums for physical metal over paper prices. You start seeing delivery delays. You start seeing exchange rule changes to manage strain on the system. Watch for these signals in 2026. Fourth, and this is the most speculative but also most important, you might eventually see policy intervention, not necessarily confiscation like 1934, because the industrial supply chain constraints make that impractical. But perhaps windfall taxes on precious metals profits, or mandatory reporting requirements, or restrictions on international movement of physical metal, or changes to how precious metals are taxed or held in retirement accounts. The specific mechanism matters less than recognizing the pattern. When governments face monetary crises, they eventually assert control over precious metals in some form. I want to be very clear. I'm not saying any of this will definitely happen. I'm saying the historical pattern suggests these are the developments to watch for if we are indeed in a fourth turning crisis approaching its climax. You can agree or disagree about whether the pattern will hold. But if it does hold, these are the signposts that would mark progression through the stages. One more thing about silver specifically that I think is important. Unlike gold, which is primarily a monetary and store of value asset, silver has this industrial component that provides a floor under prices. Even in the worst case scenario where markets crash and everything falls, silver has industrial buyers who need it for manufacturing. Solar companies need silver. Electronics companies need silver. Medical device companies need silver. That industrial demand provides support that pure monetary assets don't have. It's one reason why, in my view, silver represents a unique position in the current environment. It benefits from both monetary system stress and from structural supply constraints driven by the technology and energy transition. As we move through 2026, the developments we've discussed today will either validate or refute the fourth turning framework. Either the pattern holds and we see monetary transformation, or it doesn't, and life continues with the current system muddling through. I'll be tracking these developments and sharing analysis as events unfold, not because I have special insight into the future, but because I find the historical patterns compelling and believe understanding them helps make sense of what might otherwise seem like random chaos. Let me close with some perspective that I hope is helpful regardless of what conclusions you draw from this analysis. Monetary systems don't last forever. Throughout human history, every currency that has ever existed has eventually failed, been replaced, or been fundamentally restructured. The dollar is not exempt from this pattern. It's already undergone one major restructuring in 1971 when President Nixon ended gold convertibility. What had been a gold-backed currency became a pure fiat currency, backed only by confidence in the U.S. government. Since 1971, the dollar has lost over 98% of its purchasing power when measured against gold. An ounce of gold that cost $35 under Bretton Woods now trades above $4,000. That doesn't mean gold became more valuable. It means the dollar became dramatically less valuable over time. This debasement hasn't been smooth or continuous. It's come in waves, with periods of relative stability punctuated by episodes of rapid adjustment. The 1970s saw precious metals spike dramatically before policy intervention brought temporary reversal. The 2000s saw another sustained move higher before the 2008 crisis and its aftermath. The move that began in 2024 may represent another such episode, potentially larger than the previous ones, because the underlying debt dynamics are more extreme. Here's what gives me some optimism, despite the seriousness of what we're rediscussing. Every previous monetary restructuring has been followed by periods of prosperity and growth. The post-Revolutionary War period saw America expand and develop, despite the continental currency collapse. The post-Civil War period saw industrialization and rising living standards despite the greenback inflation. The post-World War II period saw the greatest expansion of middle-class prosperity in human history, despite the end of domestic gold ownership and massive wartime debt. The crisis is the transition, not the destination. What emerges on the other side depends on the choices made during the transition. For individuals, understanding these patterns provides context for personal financial decisions. I can't tell you what to do with your money. That's a decision each person must make based on their own situation, risk tolerance, and goals. But I can tell you that ignorance of historical patterns doesn't protect you from their effects. Being informed seems better than being uninformed, whatever actions that information ultimately leads you to take. For communities, this suggests the importance of resilience and adaptability. When monetary systems restructure, some communities navigate the transition better than others. Typically, those with strong local ties, diverse economic bases, and practical skills that remain valuable regardless of currency fluctuations. For nations, this highlights the consequences of fiscal choices made. Over decades, the debt we're discussing didn't accumulate overnight. It's the result of decisions by multiple administrations of both parties, all of whom kicked the hard choices down the road because dealing with them was politically painful. Now we're at the point where the mathematics are becoming impossible to ignore, and the next generation will live with the consequences of those deferred decisions. Silver at $80 is not an endpoint. It's a marker along a path that has been traveled before. The destination remains uncertain, but the journey is recognizable to anyone who studies monetary history. Whether you find this analysis compelling or not, whether you believe the 80-year cycle will hold or not, whether you think precious metals are overvalued or undervalued, understanding the patterns gives you tools for interpretation that pure ignorance cannot provide. We're living through a period that will be studied by future historians. The decisions made in the years ahead will shape monetary systems for generations to come. I've shared historical patterns, current data, and analytical frameworks that I believe everyone deserves to understand. The 80-year cycle places us exactly in the window when previous monetary restructurings occurred. The debt mathematics make the current trajectory unsustainable. The industrial fundamentals for silver are uniquely constrained. Whether 2026 brings the climax of this cycle or merely continued progression toward a future climax, the preparation is the same. Understanding historical patterns gives you frameworks for interpreting developments as they occur. Understanding the fundamental mathematics helps you assess official narratives critically. Understanding supply and demand realities helps you distinguish between temporary price movements and structural changes. These tools can't tell you exactly what will happen or when, but they can help you make sense of events that otherwise might seem random or incomprehensible. If you found this analysis valuable, consider staying engaged as events unfold throughout 2026. The months ahead are likely to be eventful, and having a framework for interpretation may prove valuable as events accelerate. Thank you for your time and attention. Stay curious, stay informed, and whatever conclusions you reach, I hope you reach them thoughtfully after considering all available evidence. This is historical analysis, not financial advice. I am not a financial advisor. Please consult qualified professionals before making investment decisions. Past patterns do not guarantee future outcomes, but they do provide context that I believe is valuable in navigating uncertain times.